See, most traders mark a clean zone, see a strong move away, and then assume price has to react there again. And sometimes it does, but very often it doesn't, and that's where the frustration starts, because markets don't respect zones, they respect the context. In this video, I'll show you how regime change quietly invalidates zones and what you need to look for now, not what worked back then, if you want your zones to actually hold and be successful. First, let's talk about the mistake almost everyone makes. Most traders are trained to judge a supply or demand zone by one thing only, the strength of the move away, big candles, momentum, and a clear imbalance. And if that move looks strong enough, the zone gets locked in as high probability. But here's the problem. That move away happened under very specific market conditions, different volatility levels, different participation, and different order flow. So when price comes back days or weeks later, you're no longer trading the same market, even though the zone is still sitting there on your chart. This is where traders unknowingly anchor themselves to the past. They see what used to work and they ignore what the market is doing right now. And that's exactly how perfectly valid zones keep failing. So what do we actually mean by a regime change? Well, a regime change is not a trend change, and it's definitely not just price breaking a level. A regime change happens when the behaviour of price itself changes, so how far it moves, how quickly it moves, how it reacts to pullbacks, and how much follow through you get after market reactions. For example, a zone that worked perfectly in a slow rotational market will often fail completely once volatility expands and momentum picks up. The structure will look the same and the zone will look the same, but because the market's moved, the probabilities aren't the same anymore. And this is where supply and demand traders get trapped, because they assume the zones are static, but regimes are dynamic. So when you trade a zone without first asking what kind of market you're in right now, you're essentially guessing, even if the zone itself is technically correct and has all the factors. You might look at the chart and simply say the demand zone failed, but that's not really the full story. The real story is that the market context changed. Before the announcement, traders were operating under a bullish narrative. The dollar wasn't particularly strong, the euro was holding firm, and dips into the demand zones were viewed as buying opportunities. That's why these zones formed in the first place. Institutions were accumulating positions and pushing price higher. But when the NFP numbers were released, sentiment shifted almost instantly. If the data comes out stronger than expected, it signals a stronger US economy and potentially tighter monetary policy. And that immediately changes how the institutions view and price the dollar. So suddenly the narrative flips. Instead of looking for buying opportunities on Euro USD, large players start thinking about dollar strength. And when that happens, the entire demand structure on the chart becomes much less reliable. But here's the key thing most traders miss. The demand zone didn't fail because demand suddenly disappeared. It failed because the context around that demand changed. Up until this point, the market had been in a clean 1 month uptrend. Buyers were in control, momentum candles were strong, and every pullback into demand was quickly absorbed. Traders had confidence that dips would be bought. That belief is what created the strength of the demand zone in the first place. But then something important happened. A major USD economic announcement hit the market, and the numbers came out much stronger than expected. Now here's where things get interesting. Markets aren't driven purely by price levels, they're driven by perception. And when that news came out, it instantly changed how traders viewed the balance between the euro and the dollar. Suddenly, the narrative shifted. Instead of thinking the euro is strong and buyers will defend demand, traders started thinking the dollar is gaining strength. Maybe this rally is over. And when sentiment shifts like that, the meaning of supply and demand zones changes too. What used to be a strong demand is now sitting in a completely different market environment. Buyers are less aggressive, sellers are more confident, and institutions who were previously accumulating might now be looking for liquidity to exit positions or establish shorts. You can actually see this transition happening on the chart. Price initially reacts to the demand zone, giving us that small bounce. This is the market's memory kicking in. Traders who recognise the zone step in and try to buy. But the follow-through is weak. Why? Because the broader sentiment has already shifted. The market isn't looking for higher prices anymore, it's preparing for lower ones. Then comes the decisive moment. The next wave of selling hits the market with strong bearish momentum. Those large red candles tell you institutions are now aggressively selling. And once price breaks below the demand zone, something important happens psychologically. All the traders who bought the zone are now trapped. Their stop losses sit just below the zone. As price breaks through, those stops get triggered, adding even more sell orders to the market. At the same time, breakout traders jump in short. That combination creates a cascade of selling pressure, and that's why the move down is so explosive. So the real lesson here isn't just that the demand zone failed, it's why it failed. The economic news changed the macro narrative, which changed trader sentiment. That shift altered how participants perceived supply and demand, turning what used to be a strong buying area into a level that couldn't hold under the new market conditions. So the question now becomes, how do you actually spot these context shifts before they take you out of a good trade? Because this isn't about guessing, it's about following a clear, repeatable process every time you sit down at the charts. First, you start with the economic calendar. This is your awareness layer. You're looking ahead, not reacting after the fact. Are there any high-impact releases coming up? Interest rate decisions, inflation data, employment reports. These are the types of events that completely shift market sentiment in seconds. If you see a major release within the next few hours, you need to be cautious. Either reduce risk or stay out entirely, because during these moments, technical levels become far less reliable. Next, you want to step back and define the current macro narrative. Ask yourself, what is the market focused on right now? Is sentiment bullish, bearish, or uncertain? Are we in a risk-on environment where traders are chasing returns, or risk-off where capital is flowing into safe havens? And just as important, what are central banks doing? Are they tightening or easing? This bigger picture gives you the directional bias behind your trades. Then you bring it back to your chart and confirm that your zone actually aligns with that narrative. If you're looking to buy from a demand zone, the broader sentiment should support upside. If the market is clearly bearish and you're trying to buy dips, you're going against the flow, and that immediately lowers your probability. The best trades happen when your technical setup and the macro context are pointing in the same direction. After that, you check for recent surprise events. This is where many traders get caught off guard. Unexpected news, like bank failures, geopolitical shocks, sudden policy changes, these can override everything. Even strong trends can reverse quickly when new information hits the market. So always ask, has anything happened recently that could have shifted sentiment? If the answer is yes, you need to reassess the entire context before taking a trade. Let's walk through another example of what this looks like on a chart. What you're looking at here is a market that was in a clean, structured uptrend for weeks. Prices pushing higher, creating higher highs, and most importantly, demand zones are being respected consistently. Every pullback is an opportunity to get long, and the market is rewarding that behaviour. The narrative is clear: USD strength, bullish conditions, and continuation. But then we reach a turning point, and it doesn't start with price, it starts with context. As price moves sideways, you can see equal lows forming. This is liquidity. Stops are building below these levels, and the market is preparing for a move. Now, if you're only trading technically, you might look at the demand zone and expect the same outcome as before: a bounce, a continuation, and another higher high. But this time, the environment is different. We have major economic events hitting the market. A strong NFP release comes out, which initially supports USD strength, but almost immediately, that narrative shifts with the emergence of the SVB bank failure. And this is the key moment. The market transitions into a risk-off environment. Suddenly, capital flows change. The Japanese yen strengthens as a safe haven, and the USD begins to weaken, not because of the chart, but because of the broader macro shift. And then you see the reaction. A single aggressive bearish move comes in, sweeps the liquidity below those equal lows, triggers all the stop losses, and completely breaks through the demand zone. There's no hesitation, no respect, just a clean shift in control. From that point forward, the structure tells you everything you need to know. The uptrend is over. Price starts forming lower lows and lower highs, and now it's supply zones that are being respected, not demand. So what changed? Not your strategy, not your concept of supply and demand. What changed was the market context. And this is the key takeaway. The same setup that worked perfectly for weeks failed instantly once the underlying narrative shifted. If you were still thinking buy the dip in this environment, you were trading against the market. This is why you always start with context, because it tells you whether you should even be in the trade in the first place. So if your supply and demand zones keep breaking, it's not bad luck, and it's not because supply and demand doesn't work. It's usually because you're trading zones that belong to a different market regime. The moment you stop treating zones as fixed objects and start viewing them as probability tools that only work in the right conditions, everything changes. You take fewer trades, you stop forcing reactions, and you stop getting surprised when price does exactly what the current regime suggests it should do. So the next time a zone fails, don't ask why didn't price respect it. Ask instead, should this zone have even been traded in these current market conditions? Because that question alone will save you more losses than any new indicator ever will.